Welcome back, traders and investors. This is the Benzinga pre-market prep show brought to you by Options House. I have with me Kiana Danial, CEO of Invest Diva. Kiana, welcome to the show.
Hi, I'm glad to be here.
I see that we're coming up on the one-year anniversary of your book release, Invest Diva's
Yes,
Guide to Making Money in
exactly.
Forex.
Thanks for noticing that.
How has the year been for you with the sales and everything? Has your book been well received by everybody in the community?
The book has been great, has been doing great internationally, actually, and thanks to that, our business, the Invest Diva education program, has been picking up, and our signals and everything has been selling, so it's been a great year.
Excellent, excellent. Now, I understand you're a Forex analyst. Now, is there anything new that's taking place in the Forex market that you see? Are there any new trends that you've maybe seen established recently or that you're taking a look at?
Well, today was actually a great day. Yesterday, actually, after the FOMC meeting, a lot of our long-term trades, it got out, and we made a lot of pips yesterday on pound dollar, dollar yen, and Aussie dollar. So that was great because, well, it was a joke today. I was writing on my blog that it seems that the dollar is dancing to Taylor Swift's new single, Shake It Off, because FOMC has decided to hike their rates sooner than expected. At the same time, Bank of England, they are basically under pressure to normalize their rates. So that made a lot of moves on pound. So yesterday, last night actually, we reached our target at 166.50 on pound dollar, and I actually predict that it's going to go further down towards 165.00, if not more. And another thing that I'm looking at is actually dollar yen, that it has been on an uptrend, but it was very lazy recently. It wasn't moving that much. It was consolidating, so I was waiting patiently until yesterday. Again, we reached our target at 103.92, so it's been great.
Now, what do you see as far as a central bank FX trade? Our previous guest was talking about a trade taking place between the ECB we should say Euro and US, and then taking a look at Euro and Pound. I'm wondering if there's any activity you've seen in that because of the expectations for the ECB to continue to loosen with the expectations of the Fed and the Bank of England tightening in the next year.
Yeah, exactly. So euro dollar at the same time, let me actually pull off my chart over here. Euro and pound, they usually move pretty closely to each other. So when you see a move down in pound, you usually see the move down in euro as well. And this has been the same this time as well. And we are seeing a downtrend in euro because of all the chaos that's going on in Europe. And it's not only because of the central banks, but as you know, we have a lot of other geopolitical concerns going on in Europe, including Ukraine, that has been having an effect on euro and pulling it down, basically. So a lot of investors are not excited in investing in euro as well as pound. So another concern about the UK, actually, is wage growth, which is struggling, and it's not, it doesn't have a good outlook. So all the combination is pulling pound and euro both down.
So now it seems like with an understanding of all these combinations that you can have and all these different influences on FX price, have you seen better luck doing either outright currency trades or pair trading? Has there been any one of those that has been more, enabled you to sleep better at night while still capturing, some form of return?
Well, first of all, I don't do day trading, so I always sleep well at night. I do more longer-term trading because, especially with all the things that are going on right now with all the risk events, I don't think it's smart that you do short-term trading or swing trading or scalping, because you never know when Mark Carney, for example, suddenly decides to say something and move the markets, or Janet Yellen suddenly decides to say something, as they did yesterday. Unexpectedly, they suddenly said that, okay, we're going to hike the rates earlier. So I don't do that. And as for whether I do pair trading or other, I always do pair trading. And what I do basically is I back up my fundamental analysis with technical analysis. And basically, technical analysis is my main focus for a long term, and it pays off massively on charted pair trading, because the interesting thing about currency pairs is that eventually it goes in a cycle, and all you have to do is to identify that top or that bottom and just put in your trade and wait for it to reach your target. And it may take 3 days, it may take 2 weeks, it may take 3 months, but it has proven over and over again that it goes in a cycle. So you can sleep well at night and just look out for the risk events to adjust your stop and limits. And that is the reason why I actually follow the markets and then just wait for the market to do its job and make you some pips.
So now with the longer term view and then this constant, at least monitoring of the market, do you set a hard stop that you maintain over the entire life of your trade, or do you adjust this in between? And also tangent to whether you put on hard stops or you have targets that you get out of, do you selectively scale out of positions if moves happen more than you expect in the time frame that was shorter than the one that you had established, or do you just go all in and all out on the trade right away?
Right. So excellent question. I absolutely have hard stops, because that comes from my own capital risk management, because I obviously do not want to lose more than I can afford. So the hard stops are there. I do, however, sometimes manipulate my target when I think that, okay, so I think the market is exhausting, and even though I had my target set at, let's say, 104 or 105 on dollar yen, I'm seeing that this market is moving too slow, and because in the U.S. you have the regulations that you cannot have more than 2 trades within one broker, I sometimes just, lower my greediness and lower my target and get out of that market so that I can leverage that to trade other currency pairs. So the hard stops are definitely there, but depending on the momentum and the speed of the market, I sometimes manipulate my shorter-term targets.
Okay. So now, my experience from talking with individuals is it seems like when traders first start out, they're looking for cookie-cutter ways to make money. Do this, you're going to make capital. And then as everybody seems to grow in the industry, it becomes more of, I need to switch out this tool set for, this operation. I need to bring in this tool set for this operation. So with your experience, what do you think the biggest mistakes are that investors make when they start trading currencies? Is it an over-reliance on a specific indicator, such as what Michael was just talking about, our previous guest, about certain folks really focusing on MACD levels until they break down? What mistakes do you usually see investors make when they first get in?
Well, that is definitely one of the biggest. Well, the biggest mistake is what you mentioned first, is that you want to make money quickly. In the Forex market, it never happens. Trading is never easy. Nobody said that. And anyone who tells you that you can make a lot of money in a short period of time as a new trader, they're basically lying. So the biggest mistake is the expectation of making a lot of money in a short time. The second big mistake, yes, is relying on one indicator or relying on one kind of analysis. And actually, in our education program at Invest Diva, that is what we focus on, and we call it the Invest Diva Diamond Analysis, which is the combination of technical, fundamental market sentiment, and your own capital analysis. And when I say technical analysis, I obviously do not say relying on one indicator. So a lot of people think that I'm always looking at Ichimoku because that is what I mention a lot, but the fact is you always have to combine. And how I trade is usually I take a look at the market, I get a first instinct that where this market is going, and then I back it up with multiple chart patterns, candlestick formations, indicators, because you cannot just say, okay, so the pair is moving below the Ichimoku cloud, so that means that the trend is down and it's going to remain down forever. And if you look at the chart pattern history, this never is the case. Sometimes the pair is above the Ichimoku cloud, and then it goes back down. So you always have to combine indicators, chart patterns, and candlestick formations when you're trying to do technical analysis, because indicators, they can just be accurate for so long. And if two indicators, for example, are giving you mixed signals, that is a good indication that, okay, maybe you should not trade right now. So I only trade when everything is aligned, when Ichimoku and RSI and MACD and the chart pattern and the candlesticks are telling me, all right, sell now. And even then, I still don't make a trading decision. I look at the fundamentals. I see what's going on. Is there any risk events coming up? What are people saying around the world? And then I also check out with market sentiment. Some brokers actually, they provide you with what other traders are doing. And I look at what other traders are thinking. And because usually other traders are wrong, I usually go against the market. So I back it up with 3 different kinds of analysis before I make a trading decision.
Now, do you tweak any of your measures in order to kind of grab some extra alpha? Such as when I do fundamental analysis, most folks can use a Gordon growth model or a dividend growth model in order to get an intrinsic value. Now, if everybody's using that in the market, whatever number is spit out of the model, assuming everybody's assumptions are the same, you'll get a similar number. But in order to perform well and do better than the index, you have to derive your own alpha out of the system. So I'm wondering if, with using some of these technicals, if you just use the ones that come straight out of the books or come right on the system, or if you tweak any of these to your own benefit so that you can maybe derive a little extra alpha, or maybe be able to move before everybody else can move who's using the same indicators. Because it seems like in technical analysis, if you were to switch any indicator that you're using, it might give you a false signal or a signal that wouldn't, follow through in the rest of the market.
Well, I have my regular indicators that I normally don't tweak.
Mm-hmm.
So I always have RSI and Ichimoku on my chart. Like without it, I just feel my chart is naked. And other than that, though, I just add other support and resistance levels based on channels and anything that seems relevant to me. I sometimes add a bunch of other indicators just to see and confirm if that indicator is working, and then I erase it. So I don't understand what you mean exactly by tweaking the indicator, though.
Well, I know sometimes you can switch maybe a time period that's put into the calculation, whether it's
right,
a slower,
right.
faster,
No,
stochastic.
I don't do that. No, because I'm following the market based on, as you become more experienced, you understand, you become very familiar with your own indicator. And I don't tweak it on a daily or even monthly basis because it's becoming like my friend. And
Mm-hmm.
I know what it means when, with that exact time period, what that indicator. Okay, actually, I think I got your question though. By tweaking, do you mean looking at the currency pair in different time frames?
Well, I was thinking anything really, because I've seen guys that do technical analysis, and they'll change some of the indicators to maybe be a little bit more sensitive, or to
Right.
take a look at a longer time period in order to produce what they see on the screen, such as using MACD. Maybe they'll take 20 days instead of 10 days or whatever just comes on their systems.
Right. So I don't do that with the indicators,
Mm-hmm.
but I definitely look at different time frames in the currency pair. So you either zoom in or zoom out, and that gives you an indication about the sentiment. So you want to see where euro dollar is going. And let's say you're more comfortable using the 4-hour chart. But definitely you would have to, I definitely do that, you would have to zoom in and zoom out. When you zoom in and go down, for example, to 30-minute chart, that will give you a sense of the momentum of the market. And when you zoom out and you go to, for example, a monthly chart, that will give you a sense of the general and overall direction of the market. So indicators don't tell me that much, to be honest with you. It just gives me a sense of where the market is going. But basically, you would have to play around with the charts in themselves to get the sense of what exactly is going. Or maybe, I don't know, it's probably I'm more intuitive when it comes to that, but it definitely helps for me. But I don't change the indicators' time frames.
Okay. All right. Excellent then. Now, since you do teach a course, or you explain, you try to educate people on how to trade. How much, if you had to advise somebody that was getting into currency trading, how much money do you think would be required in order to begin as a forex trader? What
Well,
what, what should people have to
begin
start
zero,
with?
obviously, because you want to test drive the market on demo accounts. Uh, and so first, my advice is when after my students are graduated from our Invest Diva program, they are required to trade for at least a month on demo accounts. And actually, we just designed our new exam services that they would have to do their analysis of their own and send it to us so that we can check out and see how accurate their analysis is on a demo account. And that will enable them to keep a diary of their own analysis. And when they're actually trading and writing down their own analysis, that will get them excited, right? And so we check their analysis and we send them back to them. And after a month, if they have consistent over 80% profit, then we would advise to start up. Then again, we cannot say how much money for like everybody. Okay, everybody has to start with $5,000. No, because different people have different risk tolerance. Different people have different capital in their account in for their life goals. You cannot just say everybody has to go under the same formula. So we actually have a formula on how much money you should put in your account, which combines your financials, current financials, your financial goals, and the leverage you're allowed to basically take on the forex market, and that gives out the money that you can start with. So definitely start small, and that small can mean $100 for some traders and $10,000 for, I don't know, Donald Trump. But you
Well,
can move up gradually then.
well, that's what I was wondering if you've seen it where guys, individuals can come in with maybe $100 as opposed to, what usually happens, at least in equity markets in the U.S., where it's suggested anywhere between 5,000 or 25,000, depending on if you want to
Right.
day trade or not.
So what you can do actually, and what I started out with, I started out actually with 10,000. I was foolish when I was a student. And that actually worked out for me, but that was beginner's like. I wouldn't suggest that to anybody. I would suggest that you put in, for example, let's say $100 and you double it. Then you take out that money. That is very important to take out the money that you make, because a lot of people, what they do, they make money in forex market and they put that money back in their investing, and then they end up losing it because they're like, oh, I made money, so they become very egotistical. So it's a very emotional kind of investing, right? So what I recommend and what I do myself is whenever I make money, whenever I reach my target, I take out that money, I buy something nice for me, I do whatever I want to do with that money, and then I put in new money. And that new money will give you, again, the responsibility that, hey, you're not allowed to lose this. Because when you put back the same money you made in the forex market, it kind of loses its charm and your responsibility.
It seems like you have a very good grasp on the psychology of how to
It
manage
is very
yourself when it comes
important. The
out here.
psychology, it's all about the psychology of the market. Because it's all about, like anybody can enter the market. It's the exiting that makes or breaks you, right? So, and that exit is very psychological, because sometimes people are so eager and they cannot realize that, okay, I made a mistake. They don't want to admit that they made a mistake, so they will just use whatever indicator to prove that their initial analysis was correct, just to get to that target. And as you make more money, that becomes more evident. So that's why you have to sometimes just take a rest and then go back in.
Now, speaking to exiting and getting out of positions, do you see what do you see as the recent taper the recent taper discussions? Has this affected currency markets at all? Has this worried you out of any positions as the summer's gone on and the Fed's become more of the instead of the elephant in the room, it's the main thing everybody's talking about now? Have you seen anything
Well,
with the taper effect on the currencies?
Well, the taper Perfect. Well, you know that from today until Saturday we have the Jackson Hole Summit coming up.
Mm-hmm.
So this discussion might come up, but it's going to be over the weekend. It's not something that is bothering me or making me concerned at the moment, because I have my well, at the moment I already reached my target, so I'm pretty happy right now. But the tapering is a little bit longer term, so I haven't actually been looking into it that much.
Okay. Now, even then, aside from the taper, when anything geopolitical hits the tape,
Yeah.
what usually happens in the currency markets? Is there always a flight to quality if it's some sort of impact that's going to take place in a specific sovereign currency?
Right. So that, as I mentioned earlier, I look out for the risk events and geopolitical events for that very reason, to adjust my stop and limit slightly so that I don't get kicked out of the market. Because what these geopolitical events do to the Forex market is it creates panic. And even though, for example, the longer term outlook is bearish, suddenly something comes up and the market panics and it goes up, but it's fake. It's a false alert. And sometimes you can just get kicked out of the market for that false alert, and the market then continues back down. So that is what to answer your question, that's what it does. So that's why you always have to be on top of the markets with what's happening so that you can adjust your stop and limit.
Okay.
But overall, like in the long term, if you're a long-term trader, which that is how I trade, that shouldn't be a big of a concern, because the market will just continue its cycle regardless.
Okay. Well, just a couple minutes left, and I kind of want to ask one last question. Then, do you feel that in the currency markets there's perhaps more jitter or more ability for people to walk away from positions or run because of the fact that in a currency market you can't calculate an intrinsic value perhaps the way that you could in an equity market, where you're looking at organic earnings of a company and you can actually calculate a company's position and an expected earnings rate. With currencies, that seems nearly impossible to really look at any country and say, okay, their currency should be valued at this, since everything's so relative. So do you feel whenever there's uncertainty, just that very basis that everything's relative, this causes folks to run, which trips out technical levels and then causes all this scurry and worry?
I'm sorry, but one thing that people don't understand is that currency trading is very different than any other kind of trading. You're absolutely right. There is no way to value a currency market. But the thing is, as I said over and over again, the currency market goes in a cycle. It never crashes, and so the stock market, eventually it will go up. It will go up. But the currency market, it's a cycle. You make money on the way down, you make money on the way up. It's very different than any other kind of trading. And in fact, it is much easier if only people could understand it. The reason why a lot of people in the U.S. are turning away from FX is because they don't understand the nature of FX. And the reason why that a lot of people in Japan and in Europe and in Australia and New Zealand are ecstatic about FX is because they understand it, because they look at the U.S. dollar and they have their own currency and they understand what it means to trade a currency pair, to trade in a pair. It's very different than stock market. It is foolish to compare it to any other kind of market. I mean, the technical analysis is the same, but the technical analysis in the long term is the same as a technical analysis for a shorter term trade in the stock market. So that is what they need to grasp. And I believe that with proper education in Forex market, you can make a lot of money, because it's the largest market in the world and it will never crash. And that should give you some confidence to not walk away from it, actually.
All right, excellent. Well, Kiana Danial, the CEO of Invest Diva, here schooling me on some Forex information this fine Thursday morning. Kiana, I appreciate you taking the time to come on and speak with us. Thank you very much.
Thank you so much. I enjoyed it. Have a nice day.
You too, Kiana. Happy trading.